Good evening, everyone. Let's give another 5 minutes to people to join in. While we are waiting for others to join, can everybody tell me what's the mix of students that we have here? What's the background? Please put it in the chat so that I understand how to conduct the classes. Do we have students who have experience with audit? Students who do not have experience with audit? Okay. So I see students who do not have experience with audit, few freshly graduate students. So the way these classes will be conducted is I'll go very baseline to make everybody understand the concepts. Um, if you are a student with experience, you're a CA, it might be a little more detailed than you expected, but considering the student mix, I think this is the best way to make everybody understand the concepts around auditing. And while we go through the classes, I will give you examples of each and every concept that we touch and read through in case you guys who have experience with audit or who are working in the audit field have any examples to share with the larger group that would benefit everybody, please do in the chat. Shortly next week, we will send out a Google form where you guys can go in, put your questions. Now, why is this Google form coming to you next week? Starting next week, we'll go into a lot of details. This week, we're doing basic chapters. So, we'll go into a lot of details. We'll try understanding concepts. And since these classes are only on the weekend, you guys would go ahead, read your chapters during the week. And if you have any questions, put it in the Google form so that we don't forget about it. And we'll have an exclusive session for only doubts. Once we have enough of them to work through. Is everybody hearing an echo or is it just me? Okay, so this is how we plan the classes. If you send any telegram messages, I may not be in a position to help you because I'm on a different time zone. I live in US, so I by the time I wake up, the questions are already answered, or there are 200 or 300 messages and your questions are lost in that. So the best way forward is to work through the classes, ask as many questions as you can during the classes. What we do is whatever we study in each class, cumulatively we revise the next session, the first 30 minutes or 20 minutes, depending on how much we've covered. And then in the last 10 minutes, I open it up for the students to ask me any questions. You can type in your questions and we can work through that. This is apart from the fact that when we are going through the class, you can put in your questions as we go through the concepts. So please make sure you note down your questions and let me know. Before we begin, what's in the audit portion for CPA, the way I would recommend everybody to study. It's not a practical subject. So definitely people find it tough to remember things. I highly recommend everybody to make your own notes. The reason why I recommend this is when you write it in your own handwriting, you tend to remember things more. So please make sure that after every class, how many ever topics we've finished, please go back. When you're studying, when you're revising, make sure you make your own notes so that you know what is required out of each chapter. At the exam, before the exam, sorry, you would not need to read the whole textbook. You have your summary notes. You can go through your summary notes. Is everybody clear? Okay. So I hope everybody has their textbooks. If not, it's okay. I also do not have the new textbook. I'm using the module out of Becker. Please make sure you guys have Becker access. You have access to our internal LMS portal. And if you do not have your textbooks, please reach out to the Simandhar team. Make sure that that's arranged for you as we go. But in case you do not have the textbooks, you still have digital copies of the textbooks in the Becker software. You can use that to study. That should not stop you from studying. Are we clear? Okay. Now, how is the Becker or how is the audit module scheduled? Like, what are the chapters? We have 6 chapters, but how is it divided? And why is it divided in that way? Before we go into that, we need to first understand the old book will not be enough for you to study. Please make sure you have the newer version of the book. Talk to Simandhar team if they can give you the new version, or do they have any differential additional study module for the new course. Make sure that you have everything that is available. Okay, now before we begin on how and what is the course structure like, can anybody tell me what is audit and why is it important? Please put in your responses in the chat. What is audit and why is it important? Can everybody please put themselves on mute? What is audit and why is it so important? People who are Googling, please do not Google. Okay, now let's backtrack. Has anybody seen the financial statements of a company? Okay, now let's backtrack even further. What are the differences between public and private company? Just give me key differences. We don't need to get into semantics. Public company is a company where public funds are invested by way of shares. The company sells its shares. The public buys it using their own funds. They are the shareholders of the company. Now, in private companies, there are no shareholders who are external to the organization. It is between a close knit group. So you do not have external stakeholders. Here you have public at large. Now, when a company has to sell shares to public at large, they have to register themselves. In US, a public company is a listed company which needs to get themselves registered, and they have to file their quarterly and annual reports with Securities Exchange Commission, which is the SEC. Public companies need to file on a quarterly basis a review financial statements, which is condensed, which is called Form 10Q, and on an annual basis, the detailed financial statements, which has all the footnotes, everything under the sun, risks, business factors, everything else. It is called Form 10K. Now, when these companies are filing their results, saying, okay, this is what my cash position looks like, this is what my earnings looks like, how does the public at large believe if this is correct or not? That is when audit comes into play. Audit is conducted by the auditors of the company. Auditors are selected by the company's board of directors and audit committee. We'll go into how auditors are selected. They go in and verify to provide reasonable assurance. It is not post-mortem of the books. It is not checking for frauds. It is just making sure that everything looks reasonably good.
Is the importance of audit.
Can everybody please put themselves on mute? Thank you. So now why is that required and why am I stressing on the term reasonable assurance? Audit is conducted in two phases. One, during the year, it's called interim audit, where you go in, you do a little bit of work for the 6 months, and at the end of the year, for the whole year, the differential audit. So it's interim and year-end audit. We'll go into the details, why it is conducted in two phases. We'll understand all of that as we go through our audit chapters. But as an auditor, you're reviewing the underlying supportings, you're making sure that everything looks good. But if it is a deeply concealed fraud, or despite of the procedures, there are some inherent limitations that might result in fraudulent activities or errors, auditors cannot detect that. So that is why it is reasonable assurance and not absolute assurance. That they have verified the books, it looks okay, no worries. That's what the auditors give an opinion on. And that is why the audit is required. They are giving assurance that the books looks okay. When the users of financial statement, the stakeholders who invested in the company, look at the audit opinion, they get comfort that their money is safe and sound. Does this make sense to everybody? Okay. Now, the way our audit chapters are structured in our portion. Audit 1 is about audit reports. That is your main conclusion. At the end of the audit, what you issue as an auditor, that is what is mentioned. Are we clear? Audit 1, the first chapter of audit, has audit reports. That is what you will issue at the end of the audit. Audit 2 talks about your engagement quality assurance, your acceptance of engagement. What do you do when you accept an engagement? Audit 3 talks about risk, evidences, and sampling. What are the procedures that you will perform when you are conducting an audit? And audit 4 is a continuation of that. You perform further procedures, form an opinion, form conclusions. Audit 5 and 6 are two different services that are rendered by accountants and auditors apart from audit. So audit 5 and 6 is a different beast. So that is how your portion is structured. Now, why is it I am not sharing any screen? I am just giving you topics that are in your textbook. So I'll share my screen once I start teaching. Why is audit 1 opinions? Why do you need to do that first instead of understanding what audit is? If you do not know the end product of the audit, which is your audit opinion or the audit reports, you will not be able to appreciate what work goes behind that. And that is why audit 1 is reports. You first need to understand reports. What are the reports? For which company, what type of reports are issued? Under what situations? If you understand that, you will understand what kind of work is required. We are backtracking. To issue those reports, what kind of work is required from the auditor? In audit 2, 3, and 4, we will understand that. Are we clear? Once you do audit 1 to 4, audit 5 and 6, the last two chapters are very, very simple, easy to understand. From an examination point of view, audit 3 and 4 are very, very heavily tested. Please make sure, at least before your exam, make sure you revise these chapters. Audit 1 is initially a little difficult to understand because there's so many reports, so many different categories. But once you go through the chapters, I think it becomes easier. And if it doesn't, we'll make it easier for you. Now, when we start with audit, the first thing that we need to understand is what goes in conducting these audits. What are the professional standards that govern these audits? Let me start sharing my screen now. One sec. I think I'm not able to share. Give me a minute. All right. Let me know if you guys can see my screen. Okay. Don't put your chat on the side. Okay. All right. Now, we need to understand what kind of professional standards govern each type of audit and what are the types of audits that are required. Now, can anybody tell me what is AICPA and what is PCAOB? Not required that everybody knows. If someone knows, please answer. Okay. AICPA stands for American Institute, of Certified Public Accountants. Now, what does AICPA do? They govern audits that are not governed by PCAOB. They also make sure the members are in good standing. They implement quality control and review standards. PCAOB is Public Company Oversight Board. They are the standard setting authorities for public companies. Now, since we are talking about US GAAP, all of this jargon is in US GAAP. Your private companies are called non-issuers and your public companies are called issuers because they issue shares to the stakeholders. Any questions on this? Any questions on this? PCAOB stands for Public Company Accounting Oversight Board. AICPA governs all the audits that are not covered by PCAOB. It is a standard setting authority for non-issuers and it also implements quality control and review standards. PCAOB is a standard setting authority for public companies. AICPA stands for American Institute of Certified Public Accountants. Non-issuers are nothing but private company and issuers are nothing but public companies. Just like there are some differences between how we say things between different locations, here public companies are called issuers and non-public companies are called non-issuers. Are we clear? Any questions before we go forward? Okay. Now, there are two more terminologies that we need to understand. One is GAAP and the second one is GAAS. GAAP, GAAP is Generally Accepted Accounting Principles. Now, every country, or location has different accounting principles to follow. When I was studying way back in 2012 for my CA final, Indian GAAP, US GAAP, and IFRS were all three different accounting standards, accounting principles, whatever you may call. There were so many differences in the way major concepts were accounted for. As I qualified in 2014, now this is 10 years back, India GAAP was reformed, Ind AS came in, and in attempt to globalize the accounting, GAAP differences between Indian GAAP, IFRS, and US GAAPs were reduced. So now accounting is almost close, but there are still differences in certain concepts between how things are accounted between Indian GAAP, IFRS, and US GAAP. Now, let us pause. Indian GAAP, we know it applies to India. IFRS is International Financial Reporting Standards. It is mostly followed by countries in Europe. Not necessarily, now again, they can be UK GAAP, they can be Ireland GAAP. This is a choice. This is International Financial Reporting Standards. So a lot of European countries, a lot of Middle Eastern countries use this to uniformly account with the world. It's called International Financial Reporting Standards, IFRS. And US GAAP is followed in the US. And a lot of companies which are subsidiaries of US in different locations would also have to follow US GAAP for their consolidated reporting. Even though they are in Europe, for example, their books will be consolidated in US for reporting in the US because it's a company in US. Are we clear with what is GAAP? Is everybody clear? Okay. Now, what is GAAS? Generally Accepted Auditing Standards. Now, audit is conducted by different auditors, different companies. The structure of the companies is different, big fours, small companies, etc. Everybody has a different method of auditing. As a matter of fact, even if the same company is auditing, between the team members, audit is very judgmental. The way I look at risk versus the way you look at risk can be different. So in order to have uniform standards around auditing, there were certain auditing standards that were issued, which the auditors on a bare minimum need to follow. That is called Generally Accepted Auditing Standards. Okay, we have a question. When it comes to regulator requirements, do they need to follow their country's GAAP or IFRS is allowed? If you're filing in your respective country, you need to follow the GAAP that is in the country. For example, I gave this example earlier on. The holding company is in US. Subsidiary is in Europe. Now, holding company needs to file consolidated financial statements. That means including all their subsidiaries. They need to file the results with the US SEC. If they need to file that, subsidiary needs to send them books in US GAAP. Now, the same subsidiary X, which is in Europe, is also a company there. They need to do the statutory filings to be a company, continue with the company status in Europe. It is called statutory filings. In Europe, they have a choice of filing with IFRS or the regular GAAP, whatever is followed. For example, I know in Ireland, they need to follow Ireland GAAP, or they can make a choice and put it in their audit report that they have followed IFRS. So they need to maintain two sets of books, one under IFRS and one under US GAAP. Okay, we have another question from a student. Even with standards in place, auditors have different perceptions of risks in particular situation. How do standards help with such situations? Okay, now let's take an example. Let's backtrack. What is Big Four? Sorry, we are going into a lot of details. There are students who do not know a lot of things around audit, so we need to go into details. What is Big Four? The top four firms that do the audit. One, Deloitte. Second, PwC. Third, KPMG. And the fourth one is EY. Now, within each organization, there are different teams who conduct different audits. The risk threshold or risk appetite changes based on team, changes based on signing partner, etc. What these standards do is they help you at least establish baseline, how much you need to cover from an audit perspective to make sure that risks of material misstatement in your financial statements are less. These standards will tell you that these are the minimum audit procedures that you need to follow. Anything beyond that is your choice, or situational based, or partner driven. They help you at least cover baseline. Now, we are required to maintain two sets of books if you are required to report under two different GAAPs, because your accounting terminology is different. Okay, now we've understood all of this. Let's go into different professional standards and guidelines that are used. The first one is Statements on Auditing Standards. It is called SAS. The section reference is AUC, and the standard setting authority is AICPA. It is for audits of non-issuers. What kind of audits? We'll see. What engagements it applies to, we'll see. Now, important things to remember. You need to remember the section references. Why do you need this? When you're doing your task-based simulations, you have one question which is a free question. Why do I say it's a free question? Because it's easy to solve, easy to score marks, and you can easily answer those questions because it's an open book question. We will go through that when we come to simulations. They will ask you what is the section reference for that particular situation that they give. If it's a non-issuer, you can type the keyword in the web search that they have inbuilt in the simulation as AUC. And then you can look up what is the authoritative guideline around that. So this will help you with that search. So important to remember. Okay, we have a question. In case of dual financial statements for both country, do we need to map adjustments and disclose in notes accounts as adjustments? Notes to accounts as adjustments. You will not do that as an adjustment. You maintain your books in two different GAAPs. You report as per those GAAPs. GAAP differences between IFRS and US GAAP are not required to be reported under any situation. Disclosures are not required. You need to follow disclosures as per IFRS when you're reporting for statutory purposes. You need to follow disclosures as per US GAAP when you're reporting under US GAAP. I can check for you if research-based simulation is removed, but I don't think they are removed. I can double check for you guys. I know they are in, but I can double check. SAS is applicable to non-issuers for audit of historic financial statements, special reports of non-issuers, and interim financial statements where annual financial statements have been audited. So, historic financial statements means after the year end, we are going to audit, right? Or if the company has not been audited for a long time, all the historic numbers, if they are audited, historic financial statements. Interim financial statements means the quarterly statements or whatever is the requirement of the private company. For example, a lot of private companies go for loans and they need the 6 monthly reviewed financial statements that the bankers need. For all those purposes, interim financial statements are given. But you can give under SAS only if annual statements are audited. So there are three types that are covered here. Interim means anything that is not annual financial statements. Unlike India, US does not follow one financial year. India has a very rigid financial year for all companies. It's April to March. Here, a lot of companies have calendar years. A lot of companies are off calendar years. Everybody does not have uniform financial year. The next one is PCAOB AS. Any financial reports that are not annual are interim in case of non-issuers. Okay. Now, PCAOB AS is nothing but their auditing standards. PCAOB auditing standards. Whenever PCAOB comes into place, it is issuers. It is for audit of annual financial statements, special reports, and interim financial statements. Yes, in US, companies can have different financial years. Homework for today. Everybody, please go do a Google search. It is very easy to get Form 10Ks and 10Qs of companies. I would like you to Google Apple latest Form 10K. It will take you to the website. If you cannot do Edgar search, please do not complicate. Please understand there are students who are new, who do not even know what is an Edgar search. Please use baseline terminology. Edgar is a website which hosts all the filings of all companies. Please do not complicate for them. Do a Google search. It will take you to the investor section of those companies where you can download Form 10K. Download Form 10K for Apple. Download Form 10K for Microsoft. Download Form 10K for Tesla. And just see the format. I don't want you to read anything. You may or may not understand. But download, see what those forms look like. Are we clear? Go do a Google search. Apple latest Form 10K. It will take you to Apple's investor relations section. Go there, download Form 10K. Same way, please do it for Microsoft, for Tesla. References. Just read or just see the format. Don't even go and read. We will go through that. Just see how the form looks like. Now, PCAOB applicable to issuers. SSARS applicable to non-issuers. Audit of historic annual financial statements, interim financial statements, and special reports in both the cases. In non-issuers case, SSARS is applicable for interim financial statements where annual financial statements have been audited. Now, why didn't they write that for PCOB? Why are they writing only this conditional thing for private companies? Mandatory for issuers to file annual audited financial statements by way of Form 10K. It is mandatory. Private companies, it is not mandatory, and that is why they are specifically mentioning. Now, what comes under special reports? For non-issuers, any reports that are submitted to the bankers for working capitals, any report that the auditor gives for different loans, covenants that are covered by the loans, all that gets covered for special reports. In case of public companies. Now, I'm not trying to complicate the understanding, but there are a lot of special forms that are filed by the company where the auditors need to give comfort letter. That is covered under special report. Now, what is a comfort letter? Auditor is giving a letter saying that the numbers in the financials look good. They have underlying documents have been tested, or it is an off-cycle report and the auditor has not conducted the quarterly review or the annual review, but yet the auditor is required to report. That is covered. Why is this comfort letter required sometimes? It is a public company. Initially, when they go public, they are allowed to issue certain number of shares to raise capital. Now they have reached their threshold. They need to file for additional authorization to issue shares. It is called new shelf in US terminology. New shelf. For that, the auditor needs to give comfort to SEC that this is what is in their books. It looks okay. These kind of reports are special reports. Any questions? This is just one example. There can be multiple reports. Comfort letter is given by auditor for off-cycle numbers. You have not conducted your quarterly review, your annual audit, or in your quarterly review, you do not do audits, right? You need to still give comfort that the numbers look correct. In the comfort letter, the auditor is saying that they look at the supports, everything looks fine in the quarterly review, and they are giving it to SEC when the company is filing for shelf for additional shares to be issued. They are giving comfort on the numbers of the company's interim numbers and any off-cycle numbers. Now, we spoke about public companies. We spoke about private companies. Okay, we have a good question that came in from Pankaj. Can we say SSARS and PCAOB AS are both generally accepted auditing standards published by different boards and followed by issuers and non-issuers? Okay. They are issued by different boards. They are generally accepted auditing standards for those respective buckets of companies, issuers and non-issuers, but there are differences. PCAOB AS is more stringent. It requires more reporting. Auditing is more tight. They need to cover a lot of risks as opposed to SSARS. They both are accepted auditing standards. When you are referring to in the audit report, you will refer them as generally accepted auditing standards. But There are differences between the two. Not just that they are issued by different boards. PCAOB AS is more stringent after the Enron fraud. PCAOB was formed and they wanted to tighten public company oversight, and they have issued auditing standards around that. Okay. Now, what is review of financial statements? We have a question. What is review of financial statements? Audit means you're going in, you're doing a lot of testing around the numbers. You're making sure that the numbers tie back to the supports. You're making sure that the controls around the numbers are fine. People are signing off as authorized, etc. When it comes to review, you're only checking on a high level if the numbers look okay. You don't need to do a lot of procedures. Okay. The next question is, what is letters to underwriters? Now, they're saying letters to underwriters, right? When a company is going public, they need certain comfort that if my public issue of shares does not go well, there are certain banks or certain venture capitals or financial institutions that will buy the shares, certain portion, to keep the company afloat. It is called underwriting. And in the process, you need to give certain letters to make sure that they have comfort that their underwriting is going to work. On a very baseline level, I'm explaining this. There are a lot of details around underwriting. Okay. Now we've spoken about public company. We've spoken about private company. Now there is one gray area. Non-profits, government companies, government programs, etc. How are they governed? Now, in the US, if government has any government, federal or state. Now, what is federal? India comparison, central government. State government, same. Federal or state, if they have given any kind of funds to a company, or if it is a government organization or a government program or activity, it is governed by GAGAS, Generally Accepted Government Auditing Standards. Now, let me backtrack. You are a public company, but you have received certain subsidies or certain funds from government to set up your manufacturing unit. Which standard would you follow? Requesting everybody to respond. You are a public company. You've received government funds, incentives, or subsidies to set up a manufacturing unit. Which standards would you follow while reporting? PCAOB AS or GAGAS? Okay, a lot of you have responded correctly. For those who have not, if there is a combination, be it a private company or a public company, and you have received any government incentives, you need to report under both. Please remember. Okay. Now we've spoken of different organizations. For audit, what standards will be followed? Now, GAGAS is required to be followed if any government funds or incentives are given to a company. even if it is a public company or a private company, if they have received government funds, government auditing standards will also apply. Any incentives given to any organization by the government, or if it is a government program or an organization, they will follow GAGAS. Are we clear? Now we have spoken about auditing. Can anybody tell me what is attestation? We've spoken about audit engagements. Now, what are the other engagements that you as an auditor or as an accountant can do? So what is an attestation engagement? An attestation engagement is basically you are giving your opinion based on examination, review, or agreed upon procedures on certain subject matter or assertion. Okay, let's pause. What is a subject matter? For example, a company wants you to give an attestation that their working capital is as per the loan covenant, that they need a working capital ratio of say 1.1, current ratio of 1, etc. That is your subject matter. You will then do an examination of the books or review or do agreed upon procedures to report whether that subject matter is correct or not. Internal controls of a company can be covered here, but only for private companies. Public companies under PCAOB are required to get their controls audited. My subject matter in this case is that I need to report on working capital being 1.2, my current ratio as per company is 1. So as an accounting firm, you have been engaged to report on whether this is right or wrong. You will then go in, either do examination or review or agreed upon procedures to conclude whether the working capital and the current ratio is correct. Attestation can be done for anybody, public company or a private company. Now, this section reference is ATC. There are another standards called Statements on Standards for Accounting and Review Services, SSARS. It is issued by AICPA, but this covers only unaudited financial statements of non-issuers. It is only covering non-issuers, that too unaudited financial statements. If you are audited, then you go directly under SAS. Okay. In this, you are allowed preparation, compilation, review of historic financial statements, preparation, compilation, review of pro forma financial information. Now, preparation is basically you're making the books. Compilation is basically you're compiling whatever books of accounts are made into a certain format. Review is you're reviewing the financial statements or historic information. Now, why is this applicable only to a non-issuer? Why not an issuer? Audit of private companies is not mandatory. Let's pause, go back. Is there possibility of both standards not aligning? In the case, companies have to follow two different standards. There are GAAP differences between each and every accounting principle. IFRS, US GAAP do not match. There are certain GAAP differences in the way we do our estimates, in the way we account for stock comp, in the way we account for our fair values. There are difference. They will not align. Okay, sorry, going back. Why is SARS only applicable to non-issuers? In case of a public company, if you are compiling the financial statements or the books of accounts, you are not independent of the company. You are not allowed to conduct audit if you are not independent. It is an independent audit of financial statements. If these engagements come into play, you cannot be independent from the company. Obviously, because you're preparing the financials, you're preparing the books, you are biased. That is why it's only applicable to non-issuers. And in case of non-issuers also, independence is mandatory. That is why only in case of unaudited financial statements, you are allowed to do this. If you are preparing the books, if you are compiling the financial statements, you are working for the management. You are not independent of the company. Your opinion is then not going to be unbiased. I have a question from a student. How can auditors be truly independent when they're getting paid by the same company they are auditing? Students who have experience with audit, can you please respond? I will clear the doubt. Please respond. Okay, let's backtrack. This was supposed to come to you guys later on, but let's backtrack. How are auditors of a public company appointed? Board of directors have a subcommittee which is called as the audit committee. They are independent board of directors. They have the reasonable expertise who will oversee how the activities of the management is conducted. They are responsible for selecting the auditor. Audit committee proposes the auditors. It is approved at the AGM or at the general meeting, and then the auditors are appointed. Management is not paying the auditor. The company is paying the auditor. And what does independence mean? Now, when we come to different standards, you'll see if there is unpaid fees, that is also not allowed. It is also a independence impairment issue. Independence here we are talking about, let's take as an example. You have a relative who is on the management of the company. You are auditing the work done by your relative. Will not biases come into play? Or you have invested heavily in the stocks of the company and you're auditing the company. And you're seeing that the way the financials look right now, the company's stock is going to tank, will come down. It is going to impair your investment also. You invested $1,000. Now it looks like you're only going to get $500. Will not your bias come into play that you would want to help management modify their reports so that your investment also comes up? That is when audits are conducted, when engagement teams are selected, an independent survey is sent out to every team member. They are required to state whether they are independent of the company that they are auditing or not. Now, You will say this is word of mouth. They will say they are independent. How do we believe? Every company, at least the big four, I work with the big four, so I don't know about the other companies. At least the big four has one risk team, which on random basis evaluates every employee's investments, their relative check to make sure that what they are declaring versus what is actually there is right or wrong. Any questions? Do you now understand how the auditor is required to be independent? Auditor who holds shares in the company, if it is substantial enough to impact the audit, you will not be allowed to be on the engagement team. You cannot be a part of the auditing team. You will just be put on any other client. Are we clear? Any doubts? If your spouse holds any shares, you are still required to disclose. Spouse, parents, children, all disclosures are required. For substantial, there is a limit. If you hold a beneficial ownership of 5%, then yes. It's not dependents. Spouse necessarily will not be dependents. Immediate family, you need to declare. Okay. Now we've understood this. Another example. You're auditing a financial institution from where you've taken an auto loan. Are you independent or not independent? The business of the company that you're auditing is to give loans, banking business. So the loans are a part of it. And the transaction is at arm's length. That means it is in market value, at par with market value. You're not given any difference interest. Third, in case of your auto loan, it is covered by your car. If you don't pay, the car will be taken away by the bank if you default. So it is in normal course. Then you are allowed to be on the audit team. Are we clear? Okay. Now we've spoken about audit engagements. We've spoken about other engagements. Under audit engagements, issuers, non-issuers, government funded or government organization. Under other engagements, attestation engagements, and accounting and review engagements. We've spoken about 5 types. Now, this is standards. Let's talk about guidelines. Now, that is standards for auditing a certain client or certain engagement, how it is required to be done. But there are certain code of ethics or professional conduct that every member, while conducting an audit, or every CPA firm is required to follow. One of those is Code of Professional Conduct. It is issued by AICPA. Every member of AICPA is required to follow Code of Professional Conduct on how to maintain high standards while conducting an audit. It gives you various compliance guidelines. It makes you understand how you should behave professionally or how you are required to ensure that all the standards are followed. Similarly, there are statements on quality control standards, QC. Again, It is issued by AICPA. It is required to be followed by CPA firms providing any type of services, auditing, attestation, accounting, review. Everything is covered. Now, what is the quality control system that they need to follow? Your audit engagements are required to be conducted in a certain manner in accordance with the policies and guidelines issued by the CPA firm, which requires audit documentation, maintaining professional standards, reporting to regulatory and legal authorities, appropriate conclusions are drawn, and making sure that everything is well documented. That is the quality control system that is required to be followed. Now, these are guidelines that are issued. Coming to the last piece of this chapter, we have everybody is required to follow the standards. Are issuers also members of AICPA even if they follow PCAOB AS? Okay, now you are confusing AICPA members and PCAOB AS. Who are members of AICPA? The auditors, people who are holding certificate of practice are members. People who have cleared their CPA are members. They will be registered with AICPA. Issuers are companies. They will not be registered with AICPA. The code of conduct is for the people who are conducting the audit, not for the companies. Are we clear? Now, we've spoken of these different standards. How do we, as auditors, know what is the most authoritative guideline and what is just interpretations? Now, the most authoritative guideline is your SAS for non-issuers, PCAOB AS for issuers. You are required to follow the guideline if the terms must, is required, or should has been used. There are certain interpretations that have been issued on the standards like clarificatory notes, FAQs, all that is interpretative. That is the second authoritative guideline. And the other publications like journals, etc., are least authoritative guidelines. They are not in the standard, that is just issued by different people. Are we clear on the guidelines? What is the most authoritative versus least? The most authoritative guideline is SAS and PCAOB AS. SAS for non-issuers, PCAOB AS for issuers. You are required to follow the text which has must, is required, should. That means it is compulsory. If it has may, could, maybe, that is an explanatory material. You may or may not follow that in your professional judgment. The second interpretative publications are the clarificatory notes that are issued on the standards or FAQs or statements of positions. That is the second guideline that you will follow. The least authoritative guidelines are other auditing publications that are issued by way of journals, by way of articles. They are the least authoritative guidelines. You cannot follow them as authoritatively. First thing you will go to is SAS and PCAOB AS. Are we clear? Can someone please bring up the question from the textbook if you guys have the textbook? There is a question behind chapter 1. Just share your screen if you guys have it. If not, then I can request Simandhar team to give me the questions. Online version, if you guys have. Or if you have the physical version, please put it in the chat. Okay. I think there is no question in the new textbook, but there was one which is, I can go back and look in the old one. It's relevant. Okay, I'll take a look at that. Let's take a quick break for 10 minutes. Come back and we'll continue with chapter 2. Thank you so much. Quick break, 10 minutes, come back. Okay, so we have one question which is talking about professional skepticism. I think this is not an MCQ which we need to do right now. That's not the right MCQ. And the second one that I have is which of the following is the most authoritative guideline for the auditor of a non-issuer? I'll read out the options. Please put in your answers in the chat. Which of the following is the most authoritative guideline for auditor of a non-issuer? A. AICPA Audit and Accounting Guide that provides specific guidance on accounting practices and principles in the client's industry. B. A Journal of Accountancy article discussing implementation of new standard. C. General guidance provided by statements on auditing standards. And D. Specific guidance provided by interpretation of statements of auditing standards. Which one is the most authoritative guidance? Which one is the most authoritative guidelines? First one talks about specific guidance provided by interpretation. So interpretations are not most authoritative guidelines. Second one, B, is a journal of accountancy. That is not the authoritative guidelines. So B is not the right answer. C talks about general guidance on statements on auditing standards. I think that is the right answer because it is statements on auditing standards. Specific guidance not covered. So you need to pick C as the right answer. People have different options in their textbooks, but the right answer, look at it, it is general guidance provided by statements on auditing standards. It may be a different option number in your textbook, but the one that I got had C. The right answer is general guidance by SAS. Are we clear? It is in the older textbook. We are just trying to solve few MCQs, and that is why I asked students to send it to me. So don't worry if it is not in your textbook. Okay? All right. Before we move to the next chapter, do you have any question on the first one? Now we are going to go into the audit process. So before we start that, do you have any questions on the first chapter? We will go into examples of attestation. The chapters that cover that is Audit 5. So you'll have plenty of examples that time. Just understand that attestation is not related to the entire financial statements. it is a particular subject matter and you need to do either examination, agreed upon procedures, or review to give comfort on that. We will cover attestation and review engagements in Audit 5. Don't worry about it. This is just an understanding. Detailed explanation, detailed examples will come in Audit 5. Please just understand what is the difference between audit and attestation and review. Audit engagements are basically audit of financial statements. They're called audit engagements. Other engagements are attestations, review, agreed upon procedures. Anything that is referred to as an engagement is a contract between the accounting firm and the company. Okay, now best way to remember, please make your own notes. Keep reading, keep rereading. You'll automatically remember. There is no shortcut to hard work. Please understand you need to spend the time to make notes. And every week we have classes on Saturday and Sunday. We will do cumulative revision. Before the class, make sure you read and come so that you are able to answer when we are doing the revision. As I mentioned, SARS and SSAEs are attestation and review engagements, which will be covered in Audit 5. You will get more information on that when we go to those chapters. Please be patient. If I give all the information right now, students will get confused. Please understand there are mix of students. We need to be cognizant of the fact that everybody needs to understand the concepts. Are we clear on the concepts that we covered in chapter 1? Okay, now let's go to the second chapter. I'll start sharing my screen again. Okay. Now, what we'll do is please post your questions when I ask you to post, because looks like a few students are getting disturbed with the flow. So what I'll do, I'll cover 1 to 2 pages. I'll stop. I'll ask for questions. Put in your questions at that time, so that everybody understands there's no break of flow. I voluntarily stop to answer your questions. Okay, now we are going to talk about the audit process. How does the audit process look like? What are we planning to do in an audit? And what is the end result? End to end, how does my audit process look like? This is a very nice flowchart that shows us how end to end the auditing process looks like. First, when you are planning to conduct an audit, let's divide this into 2 types: new client, existing client. Let's talk about new client first. Okay. You are an audit firm and you've received an inquiry from a potential client that they want you to conduct an audit of their financial statements, or you have pitched to a client that you want to do their audit, either. Now, the very first step is to understand overall objectives of that engagement. What are you trying to achieve? That's the first step. In our case, audit of financial statements for the year ended so and so. Who are the previous auditors if the audit is conducted? Who are the management team? Who are the board of directors? That is first thing that you check when you have a new client. Now, understanding the business that they do and the industry in which they operate is an ongoing process that you will do throughout the audit. But you need to have a bare minimum understanding of their business and industry to understand what is the overall ask out of the audit. Okay, you have spoken to the client. You have received the overall objective. You have understood the board structure. You've understood the management structure. Now, internally, before the engagement is accepted, you have to conduct two checks. One, client background check to make sure that the client is already does not have any problems. If they have any problems, it's a potential risk to the auditor. If the management is already accused of defrauding another company, it's a potential risk in your audit. So all those things will come out in your client background check. What do you check in client background? One, the company's background. There are multiple ways of searching it. You do the background check by looking at Google News, by looking at Crunchbase data. You look at different websites where they have registered as a company, what are the filings they have filed, etc. To make sure there is nothing that looks risky from a company perspective. Then you do a check on the key executive members of the organization to make sure that there is nothing, no red flags. Okay. Now your client background check is clear. Then you do an independence check. Independence check is to make sure your organization is independent of the client, or your organization, whatever reporting is required, that there are certain members of the organization who have investments here, etc., are reported already. Then, once the independence check is cleared, you fill out an engagement acceptance form where you list down whatever you have found during your background check, during the independence check, and what are the objectives expected out of the engagement. Summary of the first 3 steps. That's your engagement acceptance form. This in a Big Four is cleared by a risk team. They want to make sure that the risk that you're taking by signing up for the client is reasonable enough. There is nothing wrong with the client is what they're trying to determine. Independent team looking at it. If you as an audit engagement team will finalize, you want to bring the business to the firm. Every time a partner brings a new client or a new client pays for the services, partner gets share of profit. So partner will insist on taking the client. This is an independent team that is making sure that the risk is covered. Are we clear till here? It is applicable everywhere. I have done this procedure in India also. This is a check that you need to do before accepting a client, at least in the Big Four. Okay. Now, once the risk team gives approval, your engagement acceptance is done basically through engagement letter. You sign, client signs, and your engagement is live. Once you have signed the engagement letter, you need to assess the risks and plan responses. Now you are in this step. You finished this first step. Now you are in this step. Okay. The first thing you determine is what is your audit strategy? Understanding the client's business, understanding how they operate, will help you determine what are the risks in the company. How you, through your audit procedures, will respond to that risk. And you will determine materiality. Now, please do not worry about what is materiality. I'll give you a high level understanding. All these things will get covered in audit 2 and 3. Okay. Materiality is basically the threshold that the auditor is willing to let go of misstatements. For example, I am saying my materiality is $100,000. If my materiality is $100,000, however we have computed, and there is a misstatement in cash and cash equivalents for $10,000, it is below my materiality. There is no risk as such. So we are okay. But if my cash and cash equivalents has $10,000 misstatement plus $90,000 in AR plus $10,000 in inventory, that is more than $100,000. It is $110,000. That is why materiality is important. Now it is over the threshold. That means there is something wrong, and the auditor will audit further, ask for more details, perform more procedures to understand what is wrong. Are we clear? Once you've determined materiality, you've assessed your risk, you do test of controls and test of details. We will understand what is both of them. These are procedures performed in order to understand whether what is reported by the company is correct or not. After the tests are performed, you check for subsequent events and you evaluate your results to form a conclusion on the financial statements. Now, we spoke about new client. All procedures are same for the new client as to the existing client, except for determining whether you should accept the engagement or not. In an existing client, you will fill out a form for engagement continuance. On a yearly basis, you will still do your client background check. You will still see your audited financial statements to see if there are any audit report issues that need to be considered for the upcoming engagement, and if there is any risk involved. If there is not, then you continue. All procedures are same, just that instead of acceptance, you do client continuance form. I will stop here. Does anybody have doubt with the audit process flow? We will understand in detail what is test of controls, what is test of details. Please do not worry. The textbook is getting reloaded. Can everybody please put themselves on mute? Conclusions are given by the auditor in the audit report in audit opinion paragraph, which we will read through very shortly. But did we understand the audit flow? Engagement letters are mandatory for big or small companies. It is just that the background check, the risk assessment, everything is very formal in a big four. I don't think it is as formal in a smaller firm. Okay. Now, please understand that materiality is a threshold, dollar value threshold, that is set up by the auditor, saying that this is the number that we are comfortable with, that if they find any problems or any misstatements under that number, they can pass as immaterial. But if there are any issues or any misstatements that are above this number, they will have to report. Materiality is a dollar value threshold. Okay. Now, we need to understand two concepts: test of controls and substantive testing, which is also called as test of details. Now, in an organization, let's take an example. You have an invoice of $10,000, which is required to be paid. In an organization, they set up a payment matrix. 0 to $5,000, payment can be approved by accounting manager. $5,000 to $7,000, payment can be approved by the controller and accounting manager. $7,000 to $50,000, payment can be approved by controller and CFO. Anything above $50,000 has to be approved by board. This is the payment matrix that they set. Now the invoice has come for $10,000, which means the controller and the CFO need to approve it. This design where they are making sure that there is no fraudulent activities or there is a check between two things. Preparer of the invoice is someone else, approver is someone else. In the approver also they have this threshold of certain values someone will approve. This is called control design. You are putting certain checks and balances in place to make sure internally there are no frauds. As an auditor, when you're auditing the financial statements, in the same example, you will, for test of controls, check if the preparer of the invoice is X, approver of the invoice is controller Y, and CFO Z. That is your control around the payment processing. That is your test of controls. Same example, for your test of details, you will check if the invoice amount, invoice number, invoice date is tying back to the actual hard copy invoice that is provided. If the invoice has a purchase order, whether it matches to the purchase order. If the goods are received or not, you will look at the goods received note. You're matching it with different documents. And for the payment, you will trace if the payment has gone out of the bank through bank statements. In one, you're just checking if there is segregation of duties, if the control is operating correctly or not. In the second one, you're testing the details of the transaction. Do you now understand the difference between test of controls, TOC, and test of details, TOD? Does everybody understand the difference now? Okay. Now, when you're auditing the financial statements, you're auditing as per the applicable financial reporting framework of the entity. It can be either US GAAP, IFRS, or any other framework. When you're determining your engagement terms, this is one of the questions that you ask the client before engagement acceptance. What is the applicable financial reporting framework? The auditor is responsible to report on the activities of the company independently without any bias or conflict of interest in accordance with the framework that is required, applicable. Now, what is management's responsibility? We are talking about auditor's responsibility. Management is also responsible. Management means management and those charged with governance are responsible for preparation and fair presentation of financial statements in accordance with the financial reporting framework. That means auditor is only responsible to provide reasonable assurance on financial statements. Preparation and presentation of financial statements is the responsibility of the management. Second one, design, implementation, and maintenance of internal controls relevant to financial statements. In the example that I gave you, we are just checking if the preparer is different, if the approval is as per the approval matrix. We are just responsible for testing. Management is responsible to design that control, implement it, and maintain that control. Third, provide auditor with access to or information and persons in the organization to complete the audit. All the documents or the people who they want to interview are required to be given access to, and they need to understand that all the documents have to be provided. Now, why is this such a big deal? Why are we saying it is management responsibility? In a lot of cases, management refuses to provide certain documents. Now, in that case, that becomes scope limitation. The auditor cannot do the testing because management is refusing. So it impacts your audit opinion if management refuses to provide anything. Okay. Now, they have told us preparation and fair presentation of financial statements is management's responsibility. Now, what does that entail? One, it requires identification of framework, preparation in accordance with framework, and inclusions of adequate disclosure of framework in the financial statements. All this is management's responsibility. What is auditor's responsibility? Auditor has to maintain professional skepticism. That means the auditor should always plan the audit in a way where they are obtaining all the evidences required to form an opinion. The auditor needs to question every single thing. You're not going with an assumption that something is wrong. But if you receive some information, you need to think through and make sure it is correct. Complying with relevant ethical standards, exercising professional judgment, obtaining sufficient appropriate audit evidence, and complying with auditing standards. That is the auditor's responsibility. Are we clear? Substantive testing is TOD, test of details. Okay. Now, this pass key is very nice. It explains what is professional skepticism. The auditor should neither assume that the management is dishonest nor assume that they are honest. They need to make sure that whatever information is given to them is relevant and can provide evidence that the numbers are correct. That is what the auditor needs to do. Now, impediments to acting with professional skepticism. Human biases, development of inappropriate level of trust, pressure to avoid negative interactions with individuals, scheduling work demands, which may result auditor to take shortcuts. All this can cause you to have professional skepticism issues. Ethical requirements, you need to follow AICPA Professional Code of Conduct. You need to follow your state rules of the state. You need to follow your firm guidelines to make sure you're conducting your activities professionally. Now, professional judgment. Everything in audit is judgment driven. This is one area where life cannot be automated completely. Your testing can be done through AI, invoice matches can be done through AI, through tools, but at the end of the day, conclusions are human judgment driven. What does that mean? You need to make decisions on materiality. You need to make decisions on nature, timing, and extent of your audit procedures. You need to make sure whatever evidence you have obtained is enough for you to give an opinion, drawing conclusions, and making sure it is in accordance with the applicable financial reporting framework. All this is professional judgment. Any questions so far? Sufficient appropriate audit evidence. What does that mean? Enough evidence to make the auditor in their professional judgment believe that there is no material misstatement. Compliance with GAAS is basically the auditor should make sure that the auditing standards are followed. The auditor is making sure that all the auditing standards are followed in accordance with whatever act that they're following or whatever auditing guidelines that they need to follow. Now, there are 5 given here. One is PCAOB AS. Second, they may also be required to conduct the audit in accordance with ERISA, that's Employee Retirement Income Security Act, International Standards on Auditing, Government Standards on Auditing, or standards of specific jurisdiction. Wherever you're auditing, under whichever framework you're auditing, you need to follow that. The audits are done in multiple ways. You can go to the client place. The client can send documents. Most of the times we see that it is to the client's office because they don't want to send their information outside the organization. So it depends on how they want to conduct an audit. During the work from home phase, everything was online. So it was also coming online. Now, when we talk about reasonable assurance, why are we saying reasonable assurance and not absolute assurance? Despite of doing the audit as per plan, as efficiently as possible, there are certain inherent limitations on the audit, which will require or which may leave certain stones unturned. And that is why reasonable assurance is a high assurance, but not absolute level of assurance given by the auditor. We cannot check 100% of transactions. We are only checking certain samples to conclude everything is okay. And we are doing audit after the year, after the fact. We are not doing it live. So there are going to be times where certain things will be missed. For example, you are testing purchases. Your samples are 10. The total purchases are 100. Okay, you're testing 10% of it. All 10 are correct. But other 90 are wrong. You have just tested 10 and you have said, yes, it looks correct. That is the problem with audit, that you cannot test 100% of samples and you don't know whether the others are right or wrong. In the same example, you've tested 10, 90 are not tested, but all 90 are not big enough. Out of the 90, only one is very big and you did not test it. Still a problem. So because we cannot test 100%, because we are doing the testing after the fact, because we cannot uncover deeply rooted frauds through our testing, we can do as planned as possible. We can evaluate risks, conduct interviews as much as we can, but there are some inherent limitations to the audit. And that is why reasonable assurance and not absolute assurance. Now, when you're conducting the audit, you are determining the scope of your engagement. You are either hired to conduct audit of a single period, that is for 1 year, or for multiple periods. You may be hired to conduct the audit of all financial statements or single financial statements. Example, let's stop. You may be hired to conduct audit of all financial statements. That means balance sheet, income statement, cash flow, footnotes, everything. Complete suite of financial statements. Single financial statements means just balance sheet, specific accounts, certain items of financial statements. Or tax services. For non-issuers, you can do either only financial statement audit or an integrated audit, which means financial statements audit plus controls audit, operating effectiveness of controls. You can give an opinion on operating effectiveness of controls. For issuers, it is mandatory to do integrated audit. You don't have an option. This is an option only for non-issuers. Are we clear? For non-issuers, you can do financial statement audit plus audit of effectiveness of controls. For issuers, you have no choice. You have to do both. That means for non-issuers, you can do only test of details and be okay. For non-issuers, test of controls is optional. For issuers, test of controls plus test of details is mandatory. Okay. Now, what are the objectives of your audit engagement? Obtain reasonable assurance that financial statements are free from material misstatement and report on the financial statements. Communicate as per your auditing standards. When you're auditing the internal controls over financial reporting, controls relevant to reporting, you have to express an opinion that the controls are operating effectively or not, whether the controls put in place are correct and operating effectively or not. If there is a problem in the control, you have to report it. Now, this is a new addition from this year. Can be tested. So please listen in very, very carefully. We know that this is Employee Retirement Income Scheme. They are asking you to do the audit under this one, Employee Retirement Plan, Financial Statements Audit. Let's pause. What is Employee Retirement Income Scheme? In India, we have pensions. Something similar to pensions. Here, you have 401k contributions. 401k means you contribute to certain plans and in your retirement, you get certain funds on a monthly basis, something like your pension. And those plans are required to be audited. When you as an auditor are conducting an IRSA plan financial statement audit, you can accept the engagement when the basis upon which it is performed has been agreed upon. Appropriately plan and perform your financial statements audit in accordance with the Act this one. Form an opinion that it is correct or not. Express your opinion as per the IRSA Act. We will read about this in detail, how it is conducted, etc. Make sure that all your information in the financial statements audit and supplementary information is correct in accordance with SAS, and communicate to the management. This is it's same as your other audits, just that the plan under which IRSA section it is covered is different. There are some specific requirements. Are we clear? Any doubts? Pankaj, if you will tell me A11 last line, how will I be able to judge? Which one do you want me to explain? One question is audits of internal control or financial reporting must be integrated with audit of financial statement. Okay. When you're conducting your financial statements audit, you need to do your test of the, if you're doing both, you need to do your test of controls first and then test of details. Why is that important? If your control fails, that means if there is no control or control is not implemented properly, you need to do more testing of documents to make sure nothing is wrong. That is why you will do more test of details. Your first thing is checking test of controls. If controls are correct, operating properly, your details testing will reduce because you can be assured that there are a lot of checks in place. That is why they are saying you must conduct an integrated audit. We'll come to the terminologies later, where your control risk is defined, how you determine your audit strategy. Okay. These are plans that are required to be audited. For example, let me give you one India-driven example. There are certain contribution plans in India where you contribute certain percentage of your income. That plan has to be audited, not the company. If your company has set up a contribution plan, you need to audit that plan also. That plan will have a separate financial statements. We can determine how to conduct this audit. We'll discuss in detail when we get to this audit of IRSA plan. For now, just understand that it is a retirement scheme that needs to be audited. What are the objectives? Similar to any other audit, just that you are covered under IRSA section. It is, you have to follow procedures of SAS on certified investment information when management elects under this section audit. Okay, now let's stop here for today, because there's too much information for you to process. We did 2 chapters. Go back, read it, watch the Becker videos. You will understand a lot better. For students who have asked me which chapters of FAR to do when you're doing audit only, we generally recommend writing audit and accounting together. That's FAR. If you're not doing that, please go through FAR 1, FAR 2, and in FAR 3, bank reconciliation statements. FAR 1, FAR 2, and bank reconciliation statements in FAR 3. This is the bare minimum that you need to know to write your audit paper. Any questions? Any questions? Is the pace okay? Are you guys understanding? A lot of moving parts as we go through the chapters. You will be able to correlate, understand. You can choose to write the papers in the order that you want. Please use the new textbooks for FAR. Every company has policies and procedures in place which they follow for each process, that is required to be tested by the auditor. In order to file an audit report for a issuer, you need to be registered with PCAOB. We'll come to that when we are doing audit opinions. For NTE procedures, please talk to Simandhar team. I'm not the right person to give you information on that, and I do not want to give you wrong information. For nature, timing, and extent of any of the audit procedures, we will discuss in detail as we go through different categories, different audits, risks. It is all different. I have a question from a student that can we please speak up for our queries. Please understand that even putting in the questions in chat is disturbing the other students' flow. While I'm teaching, I am also looking at the chat. It sometimes disturbs my flow as well. So if a student speaks up with a query, it disturbs the flow. So we cannot let that happen. Please put in your questions in the chat. What is the method of studying? Attend the classes, go back, read the book, make summary, watch Becker videos, for you solve all your MCQs in Becker, come back to me with questions. That's the order I would recommend. We have a session tomorrow, so please design and implementation of control is management's responsibility. That means they are making sure that the control is put in place. We are testing if the control is operating correctly or not. It's called operating effectiveness. Significant amendments are already done to the portion. Don't worry if you're writing in this year, it should be okay. We are going to cover everything new. So if you're writing in June, I don't think there should be any significant changes. I cannot give you a brief of any audit. We will walk through the audit procedures. I will explain how it is conducted. Team size to how many level of people are in the engagement depends on the firm that you're working with, the partner's comfort, the team members. It's all very, very judgmental. Professional skepticism is making sure that you're testing everything with a very unbiased point of view. Professional judgment is evaluating those test results. If you're new to audit, do not worry. We will cover all the jargons in the class. If you still feel you're not comfortable, please at least Google basis of audits so that you at least understand. But we are definitely going to cover baseline for everything. If there is nothing, we'll end our class. Thank you, everyone. I'll see you tomorrow. You don't need to learn anything. Please just keep revising. It will be in your memory. Please revise what we did today for tomorrow's session. Internal audits have different guidelines. They have different standards to be followed. External auditors have different guidelines to be followed. If you're giving first papers, I would suggest study audit and FAR together. OSO is a framework. Guidance, our internal auditing standards are different. Internal audit related standards are not covered here. There are different exams for that. CIA exams. This is not CIA exam. All right. Thank you everyone for your time. See you tomorrow.